There is a belief repeated so often that it has begun to feel like a natural law. The loudest investors win. The ones on television. The ones posting daily predictions. The ones announcing every trade like a public declaration of genius. But if you examine the financial landscape with clinical precision, a strange pattern begins to emerge. The people creating the most durable wealth are rarely the most visible. They are rarely the ones explaining their moves in real time. They are rarely the ones celebrating gains publicly. And they are almost never the ones reacting emotionally to every market tremor. Instead, they move quietly, not because they lack confidence, but because they understand something most people never see. Wealth creation operates less like a lottery and more like physics. Invisible forces govern outcomes long before the results appear on the surface. Gravity does not negotiate. Momentum does not ask permission. And compounding does not care about excitement. It responds only to structure. And this is where the silent investors separate themselves from the noise. Because while the public focuses on events, they focus on systems. While others chase opportunities, they build positioning. While most people measure wealth in transactions, they measure it in trajectory. This distinction seems subtle at first, but it is not subtle. It is the dividing line between people who spend their lives chasing financial stability and those who quietly construct it. And yet, almost no one talks about the daily strategies these individuals follow. Not because the strategies are secret, but because they are psychologically uncomfortable. They require restraint in a culture of impulse, patience in an economy of urgency, and silence in a world addicted to visibility. Most people cannot tolerate that combination, which is why the majority remain trapped in the same cycle. Earn, spend, reset, repeat. Occasionally investing, occasionally hoping, but rarely building a system powerful enough to escape the loop. And this is where the anxiety quietly lives. Not the kind people speak about openly. The quiet financial tension that appears late at night. The question that slips into the mind when the distractions disappear. What if I am working hard, but structurally falling behind? Because deep down, many people sense something is wrong. They see individuals who seem calm during market crashes. Individuals who never appear rushed by economic changes. Individuals whose wealth grows steadily, while others experience violent swings. It looks almost effortless, but it is not effortless. It is engineered. Behind the calm surface is a daily framework of decisions most people never notice. Small adjustments, silent positioning, psychological discipline that compounds over years. And the strange thing is, these investors are not necessarily smarter. They simply operate inside a different mental model of money. A model where the goal is not excitement. The goal is asymmetry. Small, consistent decisions that quietly tilt probability in their favor. Over time, the effect becomes exponential. But by the time it becomes visible, the real work has already been done. And this raises a question few people ever pause long enough to examine. If silent investors are not relying on luck and not relying on constant activity, then what exactly are they doing every single day? What are the invisible behaviors that slowly transform ordinary capital into durable wealth? More importantly, why do these strategies feel so unnatural to most people? Because once you see the structure behind silent investing, something unsettling becomes clear. The financial game most people believe they are playing is not actually the one determining who wins. And the moment that realization lands, everything begins to change. But before we can examine the 5 strategies silent investors use every day, we need to expose something far more important. the invisible financial architecture that quietly controls the outcomes of millions of people. Because without understanding that system, every strategy will look like luck. And this is where the real story begins. Imagine a world where every financial decision you make is silently recorded, not by a government or a bank, but by the architecture of the system itself. Every dollar you spend, every investment you consider, every opportunity that flashes before your eyes is filtered through an invisible set of forces. These forces are neutral. They do not care about your intent. They simply amplify what is already present: your habits, your psychology, and the structure you operate within. This is the first revelation most people never fully grasp. Wealth is less about what you know and more about the systems you align yourself with. The trap most fall into is believing that visibility equals progress. They see the loud traders, the high-profile investors, the flashy market commentary, and they assume this is the structure of wealth. But the system does not reward performance in public. It rewards consistency in private. This is the hidden architecture that silent investors exploit. Consider this. The human brain is wired to respond to stimuli that are immediate. Every flashing notification, every headline screaming about a hot stock, every influencer proclaiming insider knowledge triggers a survival mechanism designed for urgent decision-making. Our ancestors survived by reacting quickly to threats. In modern financial markets, this wiring is a liability. The very neural pathways that once ensured survival now create behavioral volatility. Silent investors, however, design their environments to bypass these triggers. They eliminate the noise. They control the inputs. They operate within a framework that minimizes emotional hijacking and maximizes structural alignment. This framework is not mystical. It is observable, repeatable, and most importantly, systemic. The first element of this invisible architecture is positioning over prediction. Most people spend time trying to predict the next trend, the next market movement, the next big thing. Silent investors understand something few admit. The market does not reward prediction. It rewards readiness. Think of it like sailing. You cannot control the wind, yes, but you can adjust your sails. The silent investor aligns capital, knowledge, and opportunities in a way that allows them to capture favorable outcomes without needing to foresee every gust of the market. The second element is psychological friction control. Every financial ecosystem contains points of high friction, temptations to spend, emotional reactions to losses, herd-driven pressures. For most people, these points are traps. They appear suddenly, often disguised as normal life events. The silent investor designs buffers around these frictions, rules, automations, structural constraints, so that even under stress, the system continues to work. Money flows, decisions execute, compounding operates unhindered. Then there is time arbitrage. This is the quietest, yet most powerful lever in their system. The average person views wealth in short bursts: monthly salary, quarterly bonuses, annual gains. Silent investors see decades. They operate in a temporal dimension where patience is a weapon. Small advantages compound, and because they are consistent, the results become enormous long before anyone notices. This is why the quiet approach feels invisible. It is literally operating outside the common time frame of perception. But here's a subtlety most never realize. The system's architecture punishes deviation more than failure. A single poorly chosen investment may hurt temporarily, but abandoning the system entirely, reacting emotionally, chasing status, giving in to impatience, creates a structural collapse. This is the trap. People misinterpret short-term fluctuations as permanent verdicts on their abilities, when in reality, the architecture of wealth only punishes erratic behavior. Silent investors, by contrast, treat fluctuations as neutral data points. Their emotional calibration is a feature, not an accident. Now consider the invisible scaffolding supporting this system. It includes capital allocation discipline. Every dollar is intentionally positioned. The silent investor divides assets not by intuition, but by structural asymmetry, seeking environments where risk-reward favors compounding. Information filtering. Noise is the enemy. Inputs are carefully curated to prevent cognitive overload and reactive decisions. They understand that the human mind can only focus on a limited number of high-value signals. Behavioral calibration. Every financial action is tied to a psychological principle. Timing, frequency, and volume of transactions are consciously designed to minimize identity-based sabotage. Structural automation. Systems, rules, and routines automate consistency, making deviation the exception rather than the rule. Here is the cognitive shift you must make to grasp the first strategy fully. Money is not a linear function of effort. It is a networked function of structure and behavior. One perfectly timed investment without systemic alignment is noise. One structurally aligned system without perfect timing still compounds over time. The two together create asymmetry. And this is why shame is irrelevant. If you feel behind, if you fear you've wasted time, it is not a reflection of moral failure. It is a reflection of structural misalignment. Silent investors do not judge themselves by society's standards. They judge themselves by the system. And because the system rewards patience and alignment, they do not need permission, approval, or acknowledgement to succeed. But here's the tension. Most people operate under a false assumption of control. They believe that awareness alone is enough to change outcomes. They think, if I know better, I will do better. This is a trap. Knowledge without systemic integration is the same as ignorance. It creates hope and anxiety without leverage. Silent investors know this. They do not measure progress in awareness. They measure it in architectural adjustments. Every action is a calibration of structure, a tweak to rules, a refinement to process, a repositioning of capital. The visible results, gains, stability, resilience, emerge later, almost as a byproduct. Oh, and this is the first cognitive leap you must take to see what they do differently. Stop treating money as a reactive instrument. Start treating it as a living system, one that responds predictably to alignment and structure. By the end of this section, one question will loom over your perception. If this architecture is observable, why do most people never implement it? The answer will begin to reveal itself in the next section, when we examine the behavioral traps silently eroding wealth every day. Most people assume that intelligence or discipline alone determines financial success. But in reality, the largest obstacles are invisible, psychological, and behavioral. Silent investors understand this deeply. Wealth is not simply the sum of your actions. It is the product of behaviors allowed to compound without sabotage. The system is neutral, but humans are predictably irrational. And it is precisely these irrationalities that silently drain capital, slow compounding, and destroy potential. Consider the first behavioral trap: emotional spending. Studies in behavioral finance reveal a persistent pattern. Humans spend impulsively when triggered by emotional signals: stress, envy, status anxiety. Every luxury purchase, every unplanned treat, is a tiny but consistent leak from the compounding vessel of wealth. The interesting part is that it is rarely conscious. People do not think of their spending as sabotage. They justify it. I earned it. I deserve it. It's a small reward. But the psychology behind the transaction is the same as any dopamine-driven habit. Immediate gratification overrides long-term payoff. Silent investors engineer around this. They automate savings, predefine allocations, and limit discretionary access. By removing the opportunity for impulse, they remove the friction of human weakness. A second trap is identity-based financial self-sabotage. This is subtler, yet far more destructive. Humans anchor their behaviors to social narratives. I am the type of person who invests, or conversely, I am not the type who can manage money. Every time you act against or incongruently with your financial identity, you trigger internal resistance. This resistance manifests as procrastination, avoidance, or self-doubt. Silent investors deliberately reshape their identity scaffolding, aligning self-perception with long-term wealth creation. Their identity is not built on visible consumption or status symbols, but on systematic decision-making and structural alignment. Closely related is the trap of status-driven consumption. Social comparison is one of the most powerful psychological mechanisms in financial life. Humans naturally measure themselves against peers. We are drawn to flaunt, to display, to signal belonging. This is not inherently negative, but in the modern economy, it becomes a liability. Lifestyle inflation quietly erodes gains. A modest raise triggers luxury spending. A minor windfall triggers conspicuous purchases. Silent investors see status differently. They treat external validation as irrelevant to structural wealth. They deliberately decouple self-esteem from consumption. Now consider the illusion of control. Most people believe they can outsmart markets, predict trends, or time cycles. This belief is seductive because it appeals to logic, but it ignores the system's probabilistic nature. The human brain is wired to seek patterns, to impose causality where only randomness exists. Emotional investment in control triggers reactive decision-making. Silent investors recognize this. They do not seek control over outcomes. They control inputs. They manipulate the system's structure so that outcomes favor them probabilistically, without needing perfect foresight. Another invisible but potent trap is overconfidence and decision fatigue. Every decision has a cognitive cost. Markets, investments, and daily financial choices demand attention. Over time, fatigue compounds errors. Overconfidence leads to reckless expansion, aggressive trading, or misallocation of capital. Silent investors manage this through strict protocols, decision frameworks, scheduled evaluations, and strategic abstinence. They understand that less can compound more when executed consistently. One of the most insidious behaviors, however, is the delayed realization of minor losses. People rationalize small, repeated financial mistakes as inconsequential. A coffee here, an unplanned subscription there, a slightly higher mortgage. Individually, these actions seem trivial, but compounding ignores perception. It multiplies behavior. Silent investors treat every unit of capital as a node in a compounding network. Minor leaks are plugged immediately. Every friction point, no matter how small, is mapped and neutralized. Behavioral finance also reveals the power of framing. Most people view money through a lens of scarcity or fear. I might lose it. I am behind. I cannot risk. Silent investors reframe risk dynamically. They see capital as potential, losses as opportunities for adjustment, and fear as a signal to re-examine structure, not to panic. This is not a cognitive trick. It is a systematic psychological calibration. It ensures rational behavior dominates emotional impulses. And here's the tension that often goes unnoticed. The traps are everywhere, and they are social. Friends, colleagues, family, and media constantly reinforce patterns of impulsive spending, identity sabotage, and status-based decisions. Silent investors do not isolate themselves completely. They engineer environmental buffers. They create spaces and routines that subtly recalibrate behavioral triggers in real time. At the core, the second strategy is deceptively simple. Control your behavioral ecosystem. But its execution is intricate, requiring foresight, self-honesty, and relentless design. It is not flashy. It does not create instant satisfaction. And most people never adopt it because it demands confronting their own predictable irrationality. Yet there is a paradox. Once you see these traps, they become opportunities. Every leak you plug, every psychological friction neutralized, every identity misalignment corrected, creates structural compounding power invisible to the outside observer. This is the quiet work that separates silent investors from the reactive majority. And here is the micro cliffhanger that bridges the next insight. Behavioral mastery alone does not accelerate wealth unless paired with a mathematical framework capable of magnifying decisions over time. Without the compounding engine, all behavioral control is slow. In the next section, we will dissect how silent investors leverage capital thresholds, compounding velocity, and numeric escalation to turn structural behavior into visible, durable wealth. Once behavioral traps are neutralized, the next frontier for silent investors is mathematics, not in the sense of memorizing formulas, but in understanding the hidden mechanics of compounding, thresholds, and velocity. This is where the silent investor's strategy moves from subtle psychological control to tangible wealth acceleration. Most people underestimate this because numbers without system thinking feel abstract. But in reality, compounding is a structural law. It does not negotiate, it does not forgive, and it rewards precision over intuition. Let's start with compounding frameworks. Most people think of compounding as simply invest early and let it grow. Silent investors see it differently. They dissect compounding into multiple interlocking engines: capital compounding, the growth of principal through disciplined allocation; skill compounding, knowledge, decision-making, and insight that accumulate in a measurable way, reducing mistakes and increasing leverage; behavioral compounding, psychological consistency, identity alignment, and friction reduction that prevent leaks; optionality compounding, the ability to create asymmetric opportunities that produce outsized results. They do not treat these as separate silos. Instead, they integrate them into a single system where each engine reinforces the others. The effect is multiplicative, not additive, a subtle but enormous distinction. Now, I consider capital thresholds. Silent investors do not scatter resources randomly. They understand that certain outcomes only become available once capital reaches structural thresholds. For example, a $10,000 allocation in a diversified index fund grows steadily but cannot access private equity deals or wholesale pricing. A $100,000 position opens entry to strategic partnerships and high-conviction private opportunities. A $1 million threshold allows participation in asymmetric, institutional-level opportunities, often invisible to the public. Each threshold is not arbitrary. It is a gateway to compounding velocity. Crossing thresholds accelerates the system, not because of luck, but because of structural access. Silent investors anticipate these thresholds years in advance and design their daily actions to hit them efficiently. Next is numeric escalation modeling. Silent investors think in scenarios. If $10,000 grows at 8% annually, what is the compounding effect over 10, 20, 30 years? But they go further. They layer in behavioral risk, market volatility, and optionality, creating models where the probability of achieving a target outcome becomes predictable, not speculative. This is the difference between noise-driven investing and system-driven investing. One subtle, often overlooked concept is wealth velocity. Most people track static net worth. Silent investors track the speed at which capital moves through high-leverage channels. This includes reinvesting gains strategically, redeploying capital when opportunities arise, and capturing asymmetrical advantages before others can react. Velocity is not about reckless trading. It is about timely structural positioning. An identical portfolio with slower deployment yields dramatically lower long-term outcomes. Here's where the mathematics reveals a truth that most overlook. Small, disciplined differences magnify enormously over time. Consider this. Investor A invests $1,000 per month with 90% consistency. Investor B invests $1,000 per month with 100% consistency. At first glance, the difference seems minor, but over 30 years, that 10% inconsistency costs a fortune, not just in lost gains, but in missed threshold opportunities. This illustrates the silent power of consistency, amplified by mathematics. Another critical concept is portfolio asymmetry. Silent investors do not seek perfect outcomes. They seek favorable risk-reward ratios that maximize upside while controlling downside. They mathematically model exposure so that small wins can compound freely while losses are structurally contained. This requires discipline and foresight. Most people chase high returns without the structural containment, creating volatility that undermines compounding. The final layer is scenario-based numeric escalation. Silent investors create multiple projected pathways, from conservative to aggressive, identifying how each decision impacts thresholds and velocity. By stress testing outcomes, they transform uncertainty into a systematic playbook. Notice how this differs from conventional advice. Instead of reacting to market noise, they preemptively calculate the effects of every plausible scenario, ensuring that compounding works in their favor no matter the fluctuations. Now, by combining behavioral mastery with precisely modeled numeric systems, silent investors achieve an effect many observers interpret as luck. But luck is a byproduct of structure. Here's the subtle cliffhanger for the next section. Even with perfect compounding, discipline, and mathematical insight, intelligent people still fail. The question is, why? The answer lies not in knowledge or system mechanics. It lies in social programming, environmental pressures, and lifestyle-driven entropy. This is where we uncover the fourth hidden obstacle that quietly erodes wealth, even for the most capable individuals. Even after mastering behavioral control and compounding mathematics, intelligent and capable individuals frequently fail. And this failure is not due to lack of effort, talent, or knowledge. It is far more insidious. It arises from social programming, environmental pressure, and lifestyle-driven entropy, forces that silently reshape decisions without conscious awareness. Silent investors understand this reality and proactively design countermeasures. Let's start with social programming. Humans are inherently social creatures. Our brains are wired to conform, to follow cues from peers, family, and culture. This wiring served survival in ancestral environments, but in modern financial life, it creates invisible pressure. Friends flaunting luxury, colleagues chasing status, family members adhering to outdated money narratives, all of these signals influence spending, risk tolerance, and ambition. Silent investors recognize these cues as noise, not truth. They do not isolate themselves socially, but they curate their mental inputs, selectively engaging only with influences that reinforce structural wealth behavior. Closely tied to social programming is lifestyle inflation psychology. As income rises, humans are biologically predisposed to increase consumption, often faster than earnings grow. Luxury cars, bigger homes, expensive vacations all appear as natural extensions of income, yet they quietly drain compounding potential. Silent investors understand the trap. Each incremental lifestyle upgrade is a multiplier of behavioral friction. Instead of inflating expenses, they anchor lifestyle to structural objectives. Every discretionary choice is measured against long-term compounding potential, not immediate gratification or peer comparison. Then there is environmental pressure, the subtle forces embedded in daily life that shape decisions unconsciously. Noise, culture, accessibility, and even architecture can influence spending and investment behavior. For example, a city filled with high-end shopping districts, instant gratification culture, and constant social comparison triggers consistent small impulses that sabotage capital growth. Silent investors do not try to fight these pressures through sheer willpower. They engineer buffers and friction points in their environments, creating structural immunity to subtle sabotage. Automations, constraints, and rules act as shields against the invisible gravitational pull of consumption culture. Decision fatigue is another critical mechanism eroding financial outcomes. Every decision depletes cognitive resources. The more choices humans make, the higher the likelihood of reactive, emotionally driven errors. Silent investors, understanding this, minimize non-essential decisions. Automating savings, standardizing investment procedures, and delegating low-impact tasks preserves mental energy for high-leverage financial choices. What appears as calm composure is actually strategic cognitive preservation. Yet perhaps the most overlooked element of failure is the illusion of intelligence. Intelligent individuals often assume their knowledge alone is sufficient. They believe that understanding markets, trends, or financial principles automatically translates into successful outcomes, but intelligence without system-aligned behavior is wasted. Silent investors recognize this cognitive trap. They embed intelligence into repeatable, structured processes, ensuring knowledge transforms into compounding advantage rather than sporadic action. The cumulative effect of these social and environmental forces is subtle, yet devastating. Even someone with perfect timing, knowledge, and behavioral control can gradually bleed capital if they are exposed to unmitigated social pressure, lifestyle drift, or decision entropy. This explains why so many high-earning professionals remain trapped in cycles of wealth leakage. The system is not broken. It is simply responding predictably to behavioral input. Silent investors, by contrast, treat this environment like a dynamic field to be navigated rather than a static playground to participate in. Here is the critical insight. Intelligence and effort are not sufficient. Structure and environment are decisive. Silent investors consciously adjust both. They align every variable, social, environmental, psychological, so that compounding and velocity are uninterrupted. They cultivate patience, maintain frictions that prevent impulsive behavior, and position themselves in environments conducive to disciplined growth. This is why even highly capable individuals fail repeatedly. They underestimate entropy. Their systems are porous. Their routines are reactive rather than preemptive. And they allow micro-leaks in behavior, identity alignment, and decision-making to quietly erode long-term compounding. But there is a solution, a structural blueprint that integrates behavior, mathematics, and environmental alignment into a cohesive system. This is not guesswork. This is not instinct. This is strategic wealth architecture. Silent investors follow a step-by-step model that converts capital, time, and decisions into asymmetrical growth over decades. In the next section, we will dissect this blueprint, examining how silent investors construct asset structures, risk frameworks, skill stacks, and cash flow engines that together form the foundation of invisible yet unstoppable wealth creation. Silent investors operate not by chance, but by design. Their wealth is the outcome of a deliberate architecture where every component, capital, risk, skill, and cash flow, interlocks to amplify growth. This is not theory. It is an actionable system, a blueprint that transforms ordinary resources into durable, asymmetrical wealth over decades. To understand this, we must deconstruct each layer. Step 1. Capital structure alignment. At the foundation of the blueprint lies capital allocation. Most people think of capital simply as money in a bank or investments in a single asset class. Silent investors, however, view capital as a networked system, a set of nodes that interact to create compounding force. The structure is layered. Core assets. These are stable, low-risk holdings that serve as the base of compounding. Think of diversified index funds, bonds, or real estate with predictable cash flow. They anchor the system. Growth assets. Medium-risk positions designed for accelerated appreciation, like selective equity investments or private opportunities. These provide the engine for compounding velocity. Optionality nodes. High-risk, high-reward positions carefully sized to capitalize on asymmetric opportunities. Each node is small relative to the total portfolio, but capable of producing outsized impact. Crucially, since silent investors maintain dynamic allocation, assets are not static. They are constantly evaluated against structural thresholds, risk exposure, and potential compounding impact. Step 2. Asset acquisition logic. Acquisition is not accidental, it is tactical. Silent investors follow a framework that prioritizes strategic asymmetry. Each asset is chosen not only for potential return, but also for its interaction with the rest of the portfolio. For example, acquiring a real estate property in a high-growth but low-volatility market does more than generate cash flow. It creates leverage opportunities, tax efficiency, and optionality for larger ventures. Every acquisition has a ripple effect across the system. Step 3. Risk mitigation structure. The most visible mistake people make is pursuing growth without structural risk containment. Your silent investors invert this logic. They engineer downside protection first. This includes diversification across uncorrelated assets, insurance mechanisms, liquidity buffers, and predefined exit strategies. Losses are not feared. They are structurally contained so that they do not impair compounding engines. Risk is not avoided. It is calculated, mitigated, and asymmetrically exploited. Step 4. Skill stacking model. Wealth creation is as much about human capital as financial capital. Silent investors continuously develop skills that enhance decision quality, reduce error frequency, and expand optionality. These are not surface-level certifications or trendy courses. They are high-leverage skills that interact with financial behavior, negotiation, market analysis, tax strategy, portfolio optimization, legal structuring, and behavioral calibration. Skill stacking transforms knowledge into actionable compounding power. Step 5. Cash flow architecture. Cash flow is the lifeblood of every structural system. Silent investors design it meticulously, recurring, predictable, and aligned with compounding needs. This includes automated reinvestment of gains, predefined distributions for opportunity capture, multi-tiered income sources to maintain optionality and resilience. Cash flow is not just income. It is the circulatory system of the wealth engine, ensuring that each node continues to operate without interruption. Step 6. Long-term asymmetry. Thinking. Perhaps the most defining feature of the blueprint is temporal asymmetry. Silent investors think in decades, not months. They focus on structural advantage, not immediate gratification. They place small, irrepeated actions into a time horizon that magnifies effect, understanding that delayed compounding is the most powerful multiplier available. Every micro-decision is evaluated against its long-term systemic impact. To illustrate, consider a $50,000 allocation designed for structural compounding, $25,000 in stable core assets generating steady returns, $15,000 in growth assets capturing market expansion, $10,000 in optionality nodes prepared for asymmetric opportunities. Individually, none of these allocations appears extraordinary, but collectively, they interact dynamically. Gains in core assets increase capacity to expand growth positions. Success in growth assets enables optionality opportunities. Optionality wins feedback into both layers. The system self-reinforces. But silent investors also layer behavioral discipline into this blueprint. Every step, from acquisition to cash flow deployment, is protocol-driven. Human error is not assumed to be rare. It is assumed to be inevitable and thus mitigated through rules, automation, and structure. This blueprint is the reason why silent investors rarely panic or chase markets. They are positioned to absorb volatility, exploit opportunity, and compound consistently. Noise is irrelevant. Visibility is irrelevant. Only structural alignment and systemic integrity matter. Yet, the blueprint is not static. Silent investors recognize that compounding systems require acceleration mechanisms to take advantage of windows of opportunity. This is where the next phase emerges: dual-engine wealth acceleration, by combining active income with strategic asset deployment to exponentially amplify structural outcomes. The cliffhanger. The blueprint provides stability, but how do silent investors leap into velocity without risk chaos? That is the next module, where patience meets precision and structure meets timing. Stability without speed is a slow road to wealth. Silent investors understand that the blueprint creates compounding potential, but compounding alone does not maximize life-changing outcomes. To truly dominate financial trajectories, they deploy a dual-engine system. One engine is active income, the other is strategically aligned assets. This is the acceleration phase, a deliberate orchestration of leverage, timing, and optionality that converts latent potential into exponential growth. This Engine 1. Active income optimization. Unlike passive investors who wait for capital to grow, silent investors treat active income as a strategic fuel. This does not mean overworking or maximizing hours blindly. It means structuring income streams to complement compounding engines. Every dollar earned is mapped to structural thresholds, ensuring it amplifies existing assets or builds new nodes of opportunity. They maximize efficiency by investing in high-leverage work, roles, businesses, or projects that provide the greatest structural return for time invested. They maintain selective visibility. Income is monitored, measured, and deployed without succumbing to lifestyle creep. This is why silent investors often appear calm, even in high-pressure careers. They are not reactive. They are engineers of velocity. So Engine 2, strategic asset deployment. The second engine is capital itself, deployed with intentionality. Assets are not static repositories. They are dynamic participants in the compounding system. Silent investors time deployments around structural windows, market cycles with low volatility but high optionality. Private deals requiring capital thresholds for entry. Real estate or alternative assets with structural asymmetry. Deployment is neither rushed nor reactive. Every move is informed by probabilistic modeling, scenario planning, and cumulative effect analysis. This allows capital to accelerate without exposing the system to catastrophic downside. Optionality control. A hallmark of acceleration is leveraged optionality. Silent investors do not gamble. They structure positions so that small inputs produce outsized returns. Optionality is layered across income and assets. Income enables smaller, higher-risk experiments without threatening the structural core. Asset allocation captures asymmetric growth opportunities. Strategic partnerships expand leverage and access. Optionality is carefully calibrated, not maximal. Too much exposure destabilizes the system. Too little slows compounding. Silent investors master the Goldilocks zone, precisely balanced for maximum acceleration. Leverage management acceleration also demands mastery over leverage. Silent investors distinguish controlled leverage from leveraged risk exposure. Debt is not avoided. It is instrumented. High probability scenarios with predictable returns. Temporal alignment to cash flow cycles. Structural safeguards to prevent cascading failures. This contrasts sharply with the typical approach: borrowing without systemic alignment, chasing quick returns, or overextending in socially pressured markets. Controlled leverage amplifies velocity without eroding foundational compounding engines. Strategic timing. Windows acceleration requires precision in timing. Silent investors watch market rhythms, opportunity cycles, and internal cash flow availability to deploy capital when impact is maximized. This is why they appear unhurried. The system is ready. The window opens. They move decisively. Timing is structural, not opportunistic. Let's illustrate. A silent investor may maintain 70% of capital in steady growth assets, on 20% in optionality positions, and 10% liquid for active deployment. A sudden private opportunity emerges requiring a $50,000 entry. Because liquidity was deliberately maintained, the investor captures the asymmetry immediately, without disrupting the core compounding framework. Many observers would consider this luck. It is system-engineered acceleration. Acceleration also depends on psychological detachment. Silent investors resist the impulse to react emotionally to gains or losses. They operate in cycles, not moments. This detachment ensures that velocity does not devolve into volatility and that compounding engines remain uninterrupted. Finally, acceleration is not permanent. It is phase-dependent. Silent investors recognize windows of opportunity, but they also know when to return to structural stability, ensuring gains are preserved and optionality is refreshed for the next cycle. This phase transitions naturally into identity evolution, because accelerating wealth requires not just structural mastery, but psychological reprogramming. The individual must internalize patience, long-term vision, and delayed gratification to sustain compounding without surrendering to impulsive behaviors. The cliffhanger. Mastering acceleration is powerful, but without evolving the self to think in decades, silent investors cannot fully sustain their trajectory. The next section will explore identity evolution, where internal calibration meets strategic patience, transforming behavior into permanent wealth-aligned identity. Acceleration alone is not enough. You can build compounding engines, optimize active income, deploy assets strategically, and still fail if your identity does not evolve alongside your wealth system. Silent investors understand that long-term financial success is as much an internal psychological construct as it is an external structural one. Without evolving the self, velocity becomes reckless, optionality becomes risky, and compounding potential leaks through emotional gaps. The first internal shift is delayed gratification rewiring. Most people operate on short-term reward cycles. Every financial decision is filtered through the lens of immediate satisfaction. Can I buy it now? Will this feel good this month? Silent investors restructure this lens. They see gratification as a function of systemic alignment. The payoff is measured not in instant dopamine spikes, but in long-term structural advantage. Delayed gratification becomes a habit, not a burden, because it is tightly tied to identity. I am the type of person who prioritizes structural gain over temporary pleasure. Closely related is strategic detachment. Wealth accumulation often triggers fear, envy, and urgency. Silent investors develop detachment from outcomes in a precise, disciplined way. This is not apathy. It is emotional leverage. By detaching, they can make high-probability decisions without being hijacked by short-term noise. Markets crash, opportunities vanish, or social pressures rise. And yet, the system continues to operate seamlessly because the individual's identity is anchored to structure, not events. Another key evolution is temporal horizon recalibration. Most people think in months or years. Silent investors think in decades. This shift transforms perception. A temporary loss is no longer catastrophic. A short-term underperformance is not a signal of failure. Decisions are evaluated for their impact across decades, not quarters. Every action is measured against multi-decade trajectory, and every opportunity is assessed for asymmetric long-term value. This horizon expansion rewires fear and patience simultaneously. Identity evolution also involves reprogramming social alignment. Humans are social creatures, and social context drives financial behavior. Silent investors actively curate influence networks that reinforce their new identity. They minimize exposure to status-driven triggers, impulsive peers, or reactive cultures. Instead, they surround themselves with ideas, habits, and environments that continuously reinforce their long-term structural mindset. Yet this is invisible armor against the subtle erosions that derail most high-potential individuals. Cognitive self-calibration is the next layer. Silent investors monitor mental states, emotional triggers, and behavioral impulses. They implement feedback loops to maintain alignment between identity and structural systems. This can take the form of journaling decisions, reviewing capital allocation, analyzing behavioral patterns, or setting predefined rules for engagement. The effect is profound. Over time, identity and system co-evolve, creating a feedback loop where psychological resilience strengthens structural discipline, and structural discipline reinforces psychological resilience. Perhaps the most profound element is internalized patience. In a world addicted to speed, the ability to remain internally calm while systems compound is revolutionary. This patience is active, not passive. It requires constant calibration, observation, and reinforcement. Silent investors do not simply wait. They monitor, adjust, and ensure that the engines of wealth continue uninterrupted. The paradox is that patience, when aligned with compounding structure, accelerates outcomes faster than frantic activity. Finally, identity evolution cultivates strategic foresight under uncertainty. Silent investors can anticipate shifts in markets, behavior, and opportunity without panic. This is not clairvoyance. It is pattern recognition embedded within disciplined execution. The evolved identity allows one to act decisively, while others react emotionally. By the time volatility subsides, the silent investor has already realigned capital, captured optionality, and reinforced compounding engines. Here is the micro cliffhanger that bridges to the next section. Evolving identity alone transforms decision quality, but it also opens the door to a higher order realization. Silent investors do not stop at identity. They redefine wealth itself. Freedom, power, and legacy are reframed, and the system becomes self-sustaining on a level far beyond income or assets. The next section, Wealth Redefinition, will explore how silent investors reconstruct their perception of wealth, status, and freedom, creating a paradigm that extends far beyond conventional thinking. By this stage, the silent investor has mastered behavior, system architecture, acceleration, and identity. Yet there is one final, often overlooked shift, redefining wealth itself. Conventional society measures wealth in income, possessions, or social status. Silent investors measure it differently, in freedom, optionality, and systemic leverage. This redefinition changes not only how they act, but also how the system responds to them, creating a self-reinforcing cycle of invisible advantage. First, consider income versus structural wealth. Most people equate high income with wealth. A six-figure salary feels secure. A rising net worth feels like progress. Silent investors invert this logic. They focus on capital that works independently, building engines that grow whether they are active or idle. True wealth in this paradigm is not what you earn. It is what your systems generate and compound over time. Income is a tool, not the end point. The next is freedom beyond consumption. Traditional perspectives measure freedom by the ability to buy things: a car, a house, luxury goods. Silent investors measure freedom as the ability to choose without constraint, the ability to act strategically, to delay gratification, to reposition capital or life resources when opportunity arises. They understand that consumption alone is ephemeral. Structural freedom compounds, becomes self-sustaining, and scales asymmetrically with time and system efficiency. Power, too, is reframed. Social power, visibility, influence, recognition, is a fragile external measure. Silent investors anchor power in control over outcomes and optionality. The ability to deploy capital, make strategic decisions without coercion, and access opportunities invisible to others becomes the real metric. So this form of power is durable, quietly accumulative, and immune to social volatility. Another critical dimension is resilience over glory. Silent investors prioritize survivability and systemic endurance over fleeting victories. Wealth redefined in this way is not flashy. It does not rely on luck or external approval. It thrives quietly, growing exponentially beneath the radar, impervious to panic, fads, or the whims of the market. They also reimagine risk in service of asymmetry. Instead of attempting to eliminate risk entirely, which is impossible, they structure decisions so that upside potential vastly exceeds downside exposure. Traditional investors fear volatility. Silent investors embrace structured volatility as a catalyst for growth. Their approach transforms risk from a threat into a predictable lever. Perhaps most profoundly, silent investors redefine legacy and trajectory. Wealth is not simply for personal security. It becomes a networked force, extending optionality, freedom, and capability into multiple dimensions: family, partnerships, and institutions. It is a multi-generational, systemic perspective where each decision compounds not only financial capital, but structural influence across time. This redefinition changes the internal calculus of decision-making. Choices are evaluated by systemic impact, not immediate reward. Opportunities are measured by optionality, not visibility. Time is treated as the ultimate leverage, not a constraint. The result is a paradoxical equilibrium. They appear calm, even indifferent, but are quietly optimizing for exponential asymmetry. While the majority chases status, consumption, and fleeting trends, note silent investors operate in a higher-order domain where decisions compound silently yet powerfully. And here lies the psychological loop. By redefining wealth, the silent investor achieves structural immunity to fear, envy, and external pressures. Every move becomes intentional, every delay productive, every risk calculated. The system no longer reacts to circumstance. It creates opportunity from structure itself. Yet even at this stage, the story is incomplete. Mastery of behavior, system, acceleration, identity, and wealth perception is powerful, but without action, it remains potential. To translate all this into visible, life-changing results, one must step into the final phase, a challenge-driven, future-focused ascension where theory becomes lived reality. The micro-cliffhanger. Wealth has been redefined, systems engineered, identity aligned. But what does it take to move from invisible mastery to permanent, asymmetrical outcomes? The final section will provide the closing strategy, challenge, and call to action that binds the entire system into a coherent path forward. Now comes the moment most people avoid. It is not the moment of learning, not the moment of insight, but the moment of action and accountability. Silent investors understand a truth few acknowledge. Knowledge and structure are meaningless without execution. Systems, behaviors, compounding frameworks, acceleration engines, identity evolution, and wealth redefinition must converge in deliberate, persistent action. Here is your challenge. Take everything you have seen in this framework and ask yourself, not rhetorically, but strategically, are you willing to become invisible in your actions, relentless in your patience, and disciplined in every decision? Because the path forward is not glamorous. It does not reward attention or applause. It rewards alignment. It rewards time. It rewards those who can consistently perform when nobody is watching, who can follow structural rules that feel counterintuitive to culture, emotion, or desire. The first step is committing to a self-imposed operating protocol. Define your structural rules, daily actions, allocation discipline, behavioral buffers, and timing thresholds. Protect your compounding engines from leakage. Automate where possible. Measure, review, and adjust without emotion. Silence the social signals that urge deviation. Every day is a reinforcement of the invisible system you are building. The second step is embracing identity over impulse. Your identity must fully integrate patience, strategic detachment, and multi-decade thinking. Each choice should be filtered through this lens. Your internal calibration becomes your most powerful lever. When temptation arises, when social pressures push, when short-term fluctuations threaten your composure, you must act as the architect of your own trajectory, not a reactionary participant in others' narratives. The third step is structural execution under optionality. Opportunities will appear, some visible, some hidden. Your task is not to chase them all, but to deploy capital, time, and skill in alignment with systemic thresholds. Timing matters, but only after preparation. Velocity is not achieved by haste, it is achieved by readiness. Visualize your future self now, decades from today, operating in a system you have built, unshaken by market chaos, insulated from social pressure, and compounding consistently across income, assets, and skill. Picture the freedom to make decisions unconstrained by immediate necessity, the optionality to move when others are frozen, the quiet power that accrues without notice. This is not fantasy. It is the logical outcome of deliberate design. And here is the strategic call to action. Stop seeking permission from the world. Start engineering your system silently and allow compounding to reward you over time. Build structures. Protect behavior. Accelerate selectively. Evolve identity. Redefine wealth. Then execute relentlessly. Remember this final line. It must anchor everything you have absorbed. The world rewards those who are silent in strategy, relentless in patience, and invisible in execution. Yet fortune does not favor the loud, it compounds for the disciplined. This is your ascension. Your system is ready. Your identity is calibrated. Your wealth is redefined. Now step into it, silently, strategically, irreversibly.